When it comes to your credit score, it is the single biggest most thing during your adult life that is going to be either make it or break it depending on where your score is. If it is going to cost you an incredible amount of money that you're paying over your lifetime in interest, or are you going to get approved for loans at the best rate that they offer at financial institutions? In this video, we're going to be breaking down the credit score and continue our journey, guys. This is the third video in the series, so let me know in the comments below what you guys think. First off, payment history. It is the single most biggest part of your credit score. It accounts for 35% of your score itself. This is making timely, on-time payments to credit obligations. So if you take out a loan, you have to make it your payment on a regular basis and make it on a specific time frame. If you're late, this is going to hurt your score. If you are default, meaning that you're not paying anymore, this is going to devastate your score. If you do bankruptcy, this can absolutely crush your score, guys. Again, payment history, focus on making the payments on time. Now, this also includes minimum payments. If your credit card minimum payment is $25, make sure everything you can do in your power to make at least that $25 payment. If you can't go above and beyond to repay that debt, make sure the minimum payment, if not, the credit in the payment history is going to be affected. Second part we look at is the credit utilization. Now, this is the available credit in relationship to the credit score or the credit that you're using. So if I have a credit card with a $10,000 limit, I'm using $5,000 of that, which is borrowed. That gives me a 50% credit utilization, meaning I am using half of the line that is available. Lower utilization rates are generally favorable and will increase your credit score. That is right, guys. Same scenario, if I go from that 50% utilization down to a 20% utilization, my credit score will improve because I'm using less of my card. That accounts for 30% of your score, which again is a major part. Now, a couple of caveats to this. This is the reason, guys, if I have, again, that $10,000 limit with $5,000 used, and the credit card company agrees to increase my limit. So if my $10,000 limit now goes to a $20,000 limit on my credit card, now my 50% utilization goes to a 25% utilization. This is the big reason, guys, where a lot of people say, hey, if I close out a card, is it going to make a difference? Yes, it will, and yes, it can. And the reason being, not only are you wiping out some of the credit utilization ratios that you do have, but you are also wiping out some of the payment history. If it's a card that you've had for 3, 5, 10 years, the payment history will actually expire. The credit utilization will do the exact same, guys. So you won't have as much available credit on your credit report. So again, in this scenario, if you have two cards, both of them have a $10,000 limit. If you close out one of them, you're wiping out half of the utilization that you do have, depending on what the balance is. Now, the third one we look at is the length of credit, the credit history and the length. This is 15% of your score, guys. The length of credit history influences your score. Longer credit histories are generally viewed more positive and will yield a better score. Now, of course, if a lender pulls your credit, looks at the credit, sees, hey, this individual has, 5, 10, 15, 20 years of perfect, great payment history. Might have even been some bumps where there's a missed payment kind of here and there. But overall, the credit history is going to show your ability to pay and your credit worthiness, which is going to yield you a much better rate if your score is there. Now, number 4, we look at the types of credit. This accounts for 10% of your score. The varying types of credit includes credit cards, mortgages, installment loans, which are fixed rate, fixed term, can impact your score both positive and negative, depending on if you're managing it responsibly. Those are really the 3 buckets, guys. When you look at a credit report, one bucket is kind of the unsecured debt or the revolving debt that you carry, whether it is like a home equity line of credit, where it is a revolving debt, a credit card, things of that nature. They report as that revolving line. Mortgages, of course, on the credit report as the real estate or the mortgage balances. And then anything that is set rate, set term, like your fixed rate, fixed term, your auto loans, your personal loans, your unsecured loans, anything that is a set term. So in 60 months, you're going to pay off the loan. They will fall into that installment loan bucket. Majority of lenders like to see a mix of credit. A lot of people, younger generation, may not have a mortgages, but credit cards, installment loans, you have to build credit, guys. And I cannot stress this enough. When you turn 18, start building your credit. Start and learn to be responsible with your credit. It is going to save you money for your entire life, period. That's it. It's been proven that someone with poor credit in comparison to someone with good credit, The individual with poor credit pays about $500,000 more over their entire life in higher rates and fees than the individual that has established and well-established credit. But that means the individual with lower credit pays more for credit cards, pays more for loans, pays more for mortgages. Every single utilization that they have with that lower score, they are going to be paying a much higher rate. Number 5, we get into the new credit accounts. This is another 10%, guys. Opening several new accounts in a short amount of time can be viewed negatively because you're going in there and you're getting a lot of additional credit. Now, we see this with individuals. They'll go out, they'll open 3, 5 credit cards at the same time. Don't really know the logic short of just establishing and building up that credit. That can be viewed negatively because essentially the individual that opens 5 of those cards could go out, max out all of those cards in one day, and then of course they will absolutely tank their credit. But the amount that you have available, and this even comes into a factor when you're doing mortgages, is let's say you have $100,000 of available credit out there. A lot of institutions will want to cancel or lower some of those limits on those cards to get within the guidelines of that the government has put in place. That way you can't go out on a Tuesday and spend $100,000 and max out all of those cards. Now, the recent credit activity, this is the opening and closing of accounts, which can affect your credit score as well. You have to make sure, guys, that you're not running through a lot of revolving. 1, 2 inquiries a year are normal. When you start getting 3 to 5, it gets a little excessive. But I have seen people that have 20, 30, 40 inquiries in the course of 12 months, which is absolutely insane credit utilization and activity, and it drives their score down a lot. Now, number 7, we look at public records and collections, guys. Anything such as bankruptcies, tax liens, collections will significantly impact and lower your credit score. So keep that in mind that when you're starting to get collection bills in the mail, is it something that you can work with the collection company? When you have tax liens, guys, those have to be paid. The government can do a lot of different things, especially with the bankruptcies. See in the bankruptcy exactly what your options are for the repayment. A lot of people just want to wipe the debt clean, but it is a debt that is owed to institutions. Number 8, we look at the credit inquiries. When you do a credit inquiry, this is a hard inquiry, as they say. It has a very short, minimal impact on your score overall with the inquiries, but you have to make sure if they're going to pull your credit, are they doing a hard inquiry or is it a soft inquiry where it is not going to affect your credit? Number 9, we look at the debt levels, guys. This is the total amount you owe in absolute terms. It is what you owe overall. If you're an individual and you have $500,000 in debt and you're making $50,000 a year, that is going to be a giant red flag. Even though you have a good credit score, your debt to income ratios and a couple other factors are going to be taken into account, and you're probably not going to be able to borrow because you have an excessive amount of debt. Not only will that affect your credit score, having a lot of debt, having a lot of revolving debt, having high auto loan payments, high mortgage payments, but again, a lot of lenders will see that you're really overextended in relationship to your income, and they will not lend to you. And the final one we look at, guys, is the financial behavior, which is the most important that I focus on in this channel. Maintaining a mix of credit, paying all of your bills on time. Again, even if it is the minimum payments, guys, you have to pay your bills on time. There is no ifs, ands, or buts about it. Making sure that you are making those payments on time. Managing your credit responsibly, meaning that you are not going to have all of your credit cards maxed in their entirety, maxed out at 100% of that utilization ratio every single time that you're not paying your cards off or paying your cards down on a regular basis. Because essentially the way the credit bureaus and the way financial institutions look at it is if you're maxing out all of your cards or if you're carrying a ton of debt, you are kind of supplementing your income with debt. So if I'm not making enough money, let's say I make $5,000 a month, I'm spending $6,000 a month, 1,000 of that is going onto credit cards every single month. That is the reason I have the higher balances on the cards, because I'm not living within my means when it comes to the credit score. All right, guys, so I hope that it really summed it up with the credit score, kind of the utilization, the credit usage, and a lot more knowledge with videos to come. So if you like the content that I provide, consider subscribing to the channel, and I'll catch you in the next video.